Hey everyone, welcome to another episode of Investing Counterpoint. And since we last left you with our inflation episode, we've had some exciting developments, as I'm sure you all know. We're recording this in March 2023, and this is right after the Silicon Valley Bank failure, I guess we can say, Signature Bank failure. A lot of other small regional banks are also having some significant troubles, like First Republic Bank happens to be the bank I bank with, and a bunch of others as well. And what we're going to talk about today, we're going to talk about some of the things that led up to this. We're going to talk about some of the effects of these failures, and we're going to talk about some of the risks around the contagion and other things that people might be thinking about for around these failures. So, Daniel, let me bring you in right now, and let's get some quick thoughts on the Silicon Valley Bank failure and some other things. I mean, and don't forget in Europe too. This is U.S., but don't forget Europe. Credit Suisse. Been a long time story, but now they're really
all European banks by extension, right? We have this domino effect. So obviously, right, what do we have? We have Silicon Valley Bank, which was just a week before its collapse, rated as one of the top banks by Forbes, was basically audited back and forth, where a lot of the top tech companies held their money, went bankrupt. Now, to me, this is surprising that this particular bank would go belly up. I mean, people say that they had a complete lack of risk management. I doubt it. I think it is in the same position as all the other banks. It's very simple. Banks hold a lot of treasuries and a lot of mortgage-backed securities. That's what they do. And whatever the reserves are. Now, with Fed essentially is forcing them through regulation to hold these treasuries and then devalues them because the increase in rates makes the treasuries go down in value. Increase in rates makes mortgage-backed securities go down in value. So they had massive losses. Plus, both of these banks, I think that's not a trivial coincidence. They're both highly exposed to crypto, both Signature and Silicon Valley. Though crypto was not playing a role in their demise, like it wasn't the causative factor in any way. It was purely their losses on their book. And Silicon Valley Bank, I think, was the fastest bank failure ever. It was like 2 or 3 hours, $25 billion withdrawn. Okay. So why those particular banks? It's hard to tell, from me, honestly. I don't think they're that different from any other small to medium bank. What shocked me, though, Yon, absolutely floored me, and I don't think people are talking enough about this. On Monday morning, I think, Bloomberg came out with a story that an unnamed Treasury official says that many similar banks, meaning smaller to medium banks, are in the same position as these two. I mean, I have never, ever seen a case of, and I cannot believe this is a blunder. It almost seems like there needed to be some sort of panic, but I don't know.
No, I was going to say, I mean, that's really what led to, the First Republic Bank and some of those other smaller banks that just, I mean, First Republic Bank was down 75% in a day. I mean, that was like, I think they were the leading, but there were some other ones, other regional banks that were, the profile of these banks is very different, like you said, in terms of who they service. But JP Morgan had to jump in and backs up First Republic. And like I said, maybe I know more about that one because that is actually my bank. And so there's I'm interested in them continuing to operate. Although I do have multiple banks, and so should you, just in case something like this happens. You need your liquidity.
You should have multiple cryptos.
Maybe. And we've had this argument or discussion, I should say, for a long time, Daniel, about the effectiveness of crypto. And my contention is that it can't really be a currency because of how volatile it is. You can't have the radical volatility in a currency to the extent that it is. But I will say, and we had this conversation yesterday, that crypto has done what it is supposed to do, which is allow people to get away from the central banking systems. And it's held value, it's increased value since then, which again, isn't a bonus in my book. But I guess when you're buying something of limited supply, that's what kind of has to happen. You follow the other cryptos much more than I do. But I mean, this is really what crypto's for.
That's right. Even more shocking that Signature and Silicon Valley are two of, I think, the most exposed or among the most exposed to crypto banks out there. So this should have caused fears of them liquidating, debanking their crypto clients or whatever. It didn't happen. I think that is the biggest lesson to me. This was the time when crypto came of age because there was all these headwinds. And every time this happened before, every time there was a deflationary move, cryptos would fall. Like we argued with you about these charts that you look for a while and it seems like the crypto correlations are dropping with the market. But we all know that these correlations are meaningless in normal times. We only care about extreme times. And in extreme times, they would converge very quickly and drop like a rock. This is the first time it didn't happen. I want to say that despite being a proponent of it, I was surprised the resilience of crypto in the face of this panic. It's shocking to me because clearly a lot of people that had to sell stuff on Monday did own crypto, but they didn't sell it. And at the same time, many people who didn't own crypto filed into it.
Well, there's probably more people piling in than those that are having to sell. But, I mean, again, this is the one time that I'm not surprised, because if there is a case for crypto at all, I mean, this is kind of it. So
that's a massive case, though. That is like,
but if it fails this case, I mean, I honestly think if crypto fails this
for
case,
a risk manager, that's like holy grail. You've never had an asset like that, barring buying some options or something.
Yeah. Well, I mean, if crypto fails, or failed in this past week, and then Bitcoin's the big one. So let's say it went from 22 or 23,000 down to 10,000 or something like that. If Bitcoin crashed too, I think that's it for crypto. The case is done in our argument.
Well, I don't think it would be it, but it would be it for it as a diversified. Yes, I agree. I mean, I still think if that happened, honestly, I was wrong completely. I forecasted that there will be trouble with banks. Obviously, it's not hard to forecast that at this point, but I thought that crypto would drop to 10,000 and be a massive buying opportunity, and it didn't happen.
Man,
I thought it would drop. I thought it's still not quite yet at the stage where it could withstand this kind of onslaught. I thought it would drop, and I do still think, honestly, that there will be some actions by governments and by regulators that will try to contain crypto.
Yeah,
that will bring it down, and that will be a big buying opportunity. But maybe I'm wrong. Maybe that ship has sailed and that's it.
I don't know, but that's different to me. That crypto going down for that reason, because of government, actions, is very different than crypto going down in concert with banks.
Wait, what if you shut down two biggest crypto-related banks? That's the same thing as regular. These are not your average. This is not JP Morgan who hates crypto.
I know, but what's it mean to be a crypto-related bank?
It means that you work with a lot of crypto companies, and they hold your assets. And if you go bankrupt, they have to sell stuff. What do they have to sell? They have to sell crypto to fund their operations, to pay their salary.
I understand that, but at the same time, also their assets are safe. I mean, that so they shouldn't have to sell it any more than they'd have to sell it normally. I mean, yeah, some of their liquid US dollars are there, but if they have enough, I mean, it's not like they need to do a fire sale. So this is, you're talking about operations. So I don't know. I mean, to me,
well, I think it's psychological. I think people finally realize what crypto is for. Yeah. It's not for hedging, tech stocks. It's not for necessarily just, I mean, it is for those things, but secondarily. Primary, as you said, it's a way out of the central banking system. And Binance, the biggest exchange in the world, they had a big move, right? In the wake of all this, they moved a bunch of their assets from dollar-linked assets into actual Bitcoin. I think a great play for them. I will say a word about silver and gold, because we had a few videos about silver, about the physical silver being drained out of London. Again, I was surprised. I guess I'm too used to the contagion being just this overwhelming force. Silver and gold held up. And to me, there are two explanations, right? One of the explanations is that market is anticipating, and this is for crypto as well, the market is anticipating that the hikes will stop, the beatings will stop, the morale will improve, and then the rates will go down. But you know what? There's something fishy about that, because at the same time, oil is down, and down persistently. If you anticipate that inflation comes back with a vengeance, which it will, right? And you showed me a chart before the call, it will. If the Fed stops hiking now and drops rates, inflation will come back with a vengeance. And why would oil be down then? So to me, it's much more plausible that people are buying silver, buying gold, and buying crypto for the other reason, not for the Federal Reserve reason per se, but for the fact that they finally realized that something fundamentally is wrong with the system, and these things are outside of it to some degree.
Yeah. I mean, we talk quite a bit about inflation, and the interesting thing today, we had the inflation report come out softer than what was expected. That, coupled with what's happening with these banks. I mean, one of the reasons why these banks are in trouble, like you said, is because the Fed is forcing them to own these things that they're devaluing. So they're actively devaluing these things. So I think a lot of people are betting that, now we have a small, relatively small banking situation. The Fed's going to have to cut. They're going to have to do something that's going to stimulate, that is going to allow, they can't keep on raising because it's going to cause more failure. And now with the softer inflation, they might be thinking the same thing. But I actually think that the Fed is going to continue to raise rates. I mean, again, I'm not a Fed watcher, so don't take my word for it. But I do think they're going to do it, but at a slower pace than what was expected. So maybe a 25 basis point rise.
Well, in the previous video, I showed the chart, and you have a similar one where the inflation, when it first goes down, that's not the end of it. It then flames back up again. And I think that is on their mind as well. They're bent on demand destruction, and they will get that demand destruction. By the way, subscribe to our channel. Please like the video and please comment. Let us know what you think and what topics you want to cover. We do have a crypto related video next. Our silver video has done enormously well, over 11,000 views for our new channel. It's pretty good. But I will say this one thought that I saved for last. I really think that the biggest result of this, by far, there are some big results. The crypto held up is a big result. That silver and gold held up, and not just held up, right? Massively, did very, very well, while oil is dropping, which is very unusual. It's very unusual for gold and silver to go up as the oil is dropping. Right. I have to look at the history, but I don't think there are too many cases like that. So the last thing that I want to say that's important, that I think is overlooked by some people, that the biggest result will be massive bank consolidation. These smaller banks will go out of business. Yes, the Fed stepped in. Yes, Fed gave them the facility to use basically par. They're going to use their assets at par to get as collateral, which is amazing. That's like a free check for billions of dollars, because they can now take an asset that dropped in value, never sell it, and just use it at par as a collateral. But the bigger thing is that the smaller banks will still go out of business for many reasons. First of all, the shareholders are not protected on this scheme. So the shareholders will have to make a decision here for small banks, because there is a big flight of deposits right now to bigger banks, right? Even though they recovered to some degree, I think this is not going to go away. I think when it's all said and done, in a few months, most of these small banks will be acquired. Not just Silicon Valley and Signature, but most of the other small to medium banks will consolidate. And the large banks are not nearly subject to this panic. I mean, I'll show you a little chart that I don't have conclusive proof, but I think that this is close to it. I mean, if you look at the reverse repo, right? Reverse repo facility that the Fed has. This is for those of you who don't know, reverse repo is something that started playing really in 21. It's a way for the Fed to do QT without really doing QT. Fed has a lot of these tricks. It's like you look at it, everything is just full of tricks. So this
QT is QT is
quantitative tightening. So
just for those that don't know,
the liquidity.
Opposite of QE.
Yeah, the Fed wants to take out the cash supposedly out of the market, right, to reduce inflation. But what they wanted to do is they wanted to take this cash, yet somehow keep it in the banks. It's like, how can you do that? This is alchemy. How can you take the cash away from the banks while allowing them to keep it, so that if trouble comes back, they can use it? Well, they came up with this reverse repo facility. It was created a while ago, but it was never used until 21. And then it shot up massively. And there's like about 2 trillion right now in this reverse repo. 2 trillion. That's enormous amount of money. So what they did was the banks, it's not a repo, it's a reverse repurchase agreement. So the bank actually gave Fed the money to put into this container, this reverse repo facility. And the Fed gives the bank a security, right? But the key with these reverse repos that are really, really important, they're only 24 hours each. Right. And notice all this period, they're just like rolling them over 24 hours. They're not taking the money out. Yeah. But this means that's
not a new $2 trillion every day.
Yeah. Well, of course not. But the point is that it doesn't fluctuate a whole lot, right? It fluctuates not massively. So these banks, whoever's a participant in this reverse repo facility, we don't know exactly. This is private, supposedly, right? These people have $2 trillion at their disposal. All they have to do is within 24 hours to not prolong the agreement and take the money back, right? This means that those people who are part of this agreement to a large degree, they're immune because they have a big war chest. Now, large banks already have a lot of cash, but they also have this, and this is massive. We'll see if this repo facility will start being drawn down. So you see, I already see a drop here. See, from March 10, it's not trivial. It's not a trivial drop. I honestly didn't look at the chart. You see that this facility is being now drawn down. That's a pretty big move, just in a matter of a few days.
Yeah.
So they're using that to some degree, right, to shore up their, the bank, but also this could be used for acquisitions. It's been my long contention that this reverse repo facility is there to help large banks buy the stuff up when it drops. So the market crash comes for whatever reason. We're not going to get into conspiracy theories, even though they're true. The crash comes, and then these banks have $2 trillion. They're sitting on $2 trillion of liquidity. They can just buy everything up on the cheap, right? And I don't know who these banks are, but I looked at the Federal Reserve conditions, and it says that, basically any bank, and they expanded it to money market funds and some other things, that has over 30 billion of assets. Now, clearly, that's not a huge number, though that will exclude some, community banks and so on. Over 30 billion does, but there are some other conditions, right? You have to operate in the tri-party repo market and all these transactions. I'm just not sure. Now, clearly, like First Republic, I'm sure is part of this to some degree.
Right.
But what I'm guessing is that, and this is my guess, and please write in the comments what you think, that a large chunk of this, well, by definition, a large chunk of this will be the top 4 or 5 banks, by definition, because it's only recently that they allowed money market funds and some other things. This was expanded recently, but the amount stayed almost the same for a while. So who had a lot of cash here? It's the big banks mostly. Who needed to park extra cash? I don't think these smaller banks had a ton of extra cash to park. I mean, they were well capitalized, but the ones overflowing with money, they were just swimming in money, were large banks. And they were the ones that it was very easy for them to park it into this facility. Smaller banks, they probably just bought bonds outright, right? They bought bonds, whereas these banks, they probably have so much cash that there's not enough treasuries to buy. And for whatever reason, they just, decided to use this facility. I'm not privy, but the point is, these are probably large banks. We can see that the facility is being drawn down in a big way now. And my contention is that this is going to be one of those sources of cash that will help large banks consolidate this industry. And I fear, and I don't like it, that we're going to be left with an order of magnitude fewer banks come the fall.
Yeah, that's possible. I'm not sure that I think it's going to be an order of magnitude fewer, but there are going to be some acquisitions, especially these lower share prices. I think that you're right. I mean, I don't doubt that. They certainly didn't need the reverse repo facility to get the dollar that they needed to buy the SVB. So we'll see what happens with First Republic. I mean, that with JP Morgan backstopping them, maybe they just buy them now with these low 75% reduction in share prices and things like that before it fails. The other things that I wanted to get to Daniel today, I mean, this is maybe a little bit longer than what we like. I'd like to quickly show the chart that you were talking about that I showed you on the inflation along with the Fed funds rate. And I'd also like to show you how the yield curve has changed in just the last week since we did our last video. It's actually shocking. And maybe what I'll do is I'll start their graphic, because it's really, I mean, to me, this is shocking. So if you've watched our videos before, this chart, this green line is the current, as of today, as of 20 minutes ago or so. This is where the yield curve in the US lies. This lighter line is where the curve was just last week, 1 week ago. And I put in this dash line because this is what we're always looking at.
The biggest move ever.
I don't know if it's ever, but this is a massive move in a week. And you see what's happening. Here. Even the long end of the curve is down, but this looks a little bit flatter to me than the big moves are on the short end, which is where the big mismatch was before. But this is a huge move in Treasury. Now, I was also interested in how this is going to play with the potential of a debt default, which is political, but we're not going to get into that right now. I mean, with Congress playing around.
Separate episode for that.
Separate episode, but this is interesting to me. The other one that I wanted to show is this one, which is the Fed. Here we have the Fed funds rate on the left. That's the red line, and CPI is the blue line. And what you were talking about, Daniel, was kind of these reliefs that they kind of start to back off. You see inflation going up, the Fed starts to raise, and then they start to back off. They see a little bit of a break, but then it just takes off again. This is the 70s, and a lot of people are likening this current period of inflation to the 70s.
Yeah.
So I wanted to show that, but I was listening to one of the Fed governors, former Fed governors, I should say, talk. And he was saying that, this is what happened in the 70s, is that the Fed started to tighten and they stopped because they thought they started to have it under control, or they had something else that they needed to stop for, like a Silicon Valley Bank, where they thought they needed to stop, and inflation started to run amok. What I think we want to, I think the Fed probably knows this as well, because I learned this from a former Fed governor. So the Fed knows this. I don't think they're going to make that mistake, or they're going to, because they've said that their number one goal is inflation. So I think they're going to do something small, but they're not going to start to ease. I don't believe that.
I agree. I think that for maybe a slightly different part of this is this reason, but they're hell bent on destroying the demand. They're hell bent on creating some sort of a event, and I don't know exact reasons for that. But higher for longer was the mantra. Powell said, remember at the Jackson Hole, I think it was August, he said, you got to prepare for shocks.
Yeah.
He literally used the word shocks, I think one of the very few times in the history of central banking. But lately we've seen that word, and we heard that word used over and over again by bankers. So I don't think they're completely oblivious. I'm not in the camp of people who likes to laugh at the clueless Powell and the clueless Yellen. I don't think they're clueless.
No,
I
they're
just
not.
think that they have some sort of goal that and then they're pretty open, right? We have to destroy demand. We have to see unemployment weaken, which to me sounds
they've
crazy.
said those things. Yeah, absolutely. They've been very explicit. They've said those things out loud.
Unemployment. You have to, there are other ways to fight inflation, but the problem is right now, it is strictly speaking, mathematically impossible to fight inflation without ruining the economy, just because of the debt. In the 70s and 80s, you did not have that much debt. And U.S. Treasuries, close to 28% or 30% of them come due within 1 year. U.S. has a lot of debt to repay. Now, I'm not one of those analysts that thinks like, oh, the dollar is going away because China sold some sneakers for yuan. I think the dollar is entrenched in a much different way than people realize. But at the same time, this amount of debt makes it virtually certain that these hikes will destroy the economy. And we said that on the show multiple times. And honestly, I think that the people think that just because of this, it may seem like a lot to us, but I think what the Fed took away from this is things are not nearly as bad as you thought. The world was ending one day, and tomorrow with just $25 billion. What is $25 billion nowadays? It's peanuts for them. With just $25 billion, we backstopped the whole thing and the markets are back up again. Yeah. I think they took exactly the opposite lesson. So I'm not a big betting person, but I would be betting that there'll be no easing, even if situation gets much, much worse.
I'm with you, and I think we got to leave it there for today. But this is a packed episode. This is some exciting stuff. If you're analyzing it, might not be exciting if you're a Silicon Valley Bank shareholder or depositor. It might be a little more tenuous, but this is stuff. We didn't get into doing some stress tests. We've done some stress tests around this event. We're having a challenge.
Subscribe to the channel.
Yeah.
Old Chinese curse, may you live in interesting times,
Yeah.
All right, take care, everybody. Subscribe to the channel, write a comment.
Thank you.